Hi everyone, good evening, and thank you for joining on this webinar on a Saturday evening. Generally, we have all our webinars very focused on investing, updates on the stock market, updates on companies which we are eyeing for, taking a position into. This time we have something very different lined up. We are trying to kind of do a webinar which helps you get a sense of how we can manage our taxation better, specifically for NRIs. The idea is that there are certain things which NRIs can do and which we found that none of our clients were aware of, and which are very interesting, which can save some phenomenal amount of taxes for clients, which was absolutely unknown to most of the people. And that's where we have our guest speaker today, Mr. Abhishek Khurana. I'll just give you a quick intro for Abhishek ji. He is a chartered accountant by education and has worked across multiple big four companies specializing in tax for over 15 years. He's handled very large clients, MNCs, Nifty 50 listed companies, and he has managed their direct taxation, structuring, ESOP management, intercountry tax compliances, foreign exchange management, so on and so forth. And he is, I can say with some assurance, that he's one of the few people who would have that kind of a grip into on taxation when it comes to moving in India, outside India, and to kind of invest it either in India or globally as well. So with that introduction, I would kind of welcome Mr. Khurana to come and take over this presentation. I think people are still joining, but it's about 3:08, so I think we should get started with the introductions and everything. Hi Abhishek, how are you? Good evening.
Thank you so much, Abhishek, for such a nice introduction. Good evening, everyone. It's a pleasure hosting this webinar for you today. Thank you, Abhishek, for this opportunity, and look forward to interacting with all of you and taking you through some of the key provisions that could benefit our NRI audience. And I'm sure you would find this session very helpful.
Perfect. Thank you so much. So how we've structured it before we kind of kick this off, typically we'll have a 20-30 minute session on the key provisions that we feel are unknown to people and which might be meaningful to know. We have a 10-minute session on how Gift City has come up and what are the interesting aspects of investing in the Gift City. And the last 10-15 minutes, like always, we'll be reserving for Q&A. Because this will be very data intensive and packed with a lot of information, if you have any questions, please feel free to keep putting it on the chat, so that by the end of the call, when we actually reach the Q&A, we already have a list of questions which we can start getting answers to. At the end of the presentation, we have some very interesting packages for the audience, wherein we will try and see if we can help you out solve your tax problems, which you will realize after you kind of go through the content that we have to presenting. So with that, Jain, if you want to kind of move to the next slide, and we could kind of start. Jain, can you move to the next slide, please? Perfect. So, Abhishek, would you want to get started, or do you want me to give a quick intro? Yeah, please. Thank you.
I'll take over. Thank you so much, Abhishek. So we'll start with some of the basics. I'll give you an overview of what common pitfalls of NRI taxation look like, and what I've come across in my career of last 13-14 years. So predominantly what I've seen is that most NRIs are unaware of the basic mistake that they make is filing an incorrect ITR form. They feel that an ITR1, which is the simplest of all income tax return forms, is something that would befit them, but that is absolutely incorrect. As per the forms which are issued by the income tax department every year, ITR1 is applicable only to residents. It is not applicable to non-residents. So even if you have, say, basic income here in India, you have to file ITR2, or if you have business income, then you'll obviously have to move to ITR3. We can move on to the next slide, Jay. Thank you. Here, I would just basically spend, say, 5 minutes on how a person becomes a non-resident during a given tax year. It's a pretty complicated slide, so we'll not basically get into the intricacies of say, residency determination, but I'll touch upon some of the important aspects that are relevant to non-residents. So first and foremost, say, for a person to qualify as a non-resident, the basic criteria is that if that person is in India for less than 60 days in any financial year, and by financial year I mean 1st April to 31st of March, if the person is in India for less than 60 days, then that person becomes a non-resident. Okay. Similarly, for people who are Indian citizens and who are in India for more than 60 days but less than 182 days, and who are leaving India for the purpose of employment outside India, there is a special condition that the 60 days condition that I spoke about does not apply. And for them, the 60 days condition is substituted by 182 days. So if you are leaving India in a given financial year for the purpose of employment outside India, then the 60-day condition is not applicable. And even if you're in India for less than 182 days during that financial year, then you would still end up qualifying as a non-resident. Now, the law says that you have to leave India for the purpose of employment outside India, but there have been judicial precedents wherein it has been upheld that even if you are leaving India for the purpose of self-employment, say practicing a profession outside India, or for, say, developing your own business, that would also say tantamount to leaving for the purpose of employment outside India. So it would it will be aligned with the legislative intent of bringing this provision. Then there is another provision that is applicable to non-residents in the sense that if you are an Indian citizen or a person of Indian origin, by a person of Indian origin, I mean if the person himself or either of his parents or any of his grandparents, if they were born in India, then that person becomes a person of Indian origin automatically. So if that person is outside India and he comes to India for visits, the visits can be both professional or personal in nature. Okay.
I have muted, please go ahead.
Okay, sure. So if that person is outside India and comes to India for visits, then also the 60-day condition does not apply. For them also, the relevant condition is 182 days in a given financial year. For this, it's not relevant when you are leaving India. You should have been habitually staying outside India for the visit condition. Now, an interesting concept here is, and this was brought, say, 5 years back, this amendment was brought in 5 years back, and they saw a lot of people who just come in and out of India for the purpose of becoming a non-resident. So what they did was, the department had introduced a provision to say that if you are a Indian citizen or a person of Indian origin, and if your Indian sourced income is greater than 15 lakh rupees, which is 1.5 million, then this 60 days condition gets substituted by 120 days. So if, say, your Indian sourced income is more than 15 lakh rupees and you are in India for 120 days or more and 365 days or more in the preceding 4 years, then you will not be a non-resident. You will be a resident, but not ordinarily resident. What that means and what its implications are, we'll discuss on the next slide, and maybe we'll come back to this slide one more time after that. But you will not be a... So for a person whose Indian sourced income is more than 15 lakhs, you would need to see this 120 days threshold. If you are less than 120 days, then you will still end up qualifying as a non-resident. I'm sure this can be a bit confusing for people who are hearing this for the first time. But happy to means please feel free to ask questions and keep jotting down your questions or put them in the chat box, and we'll be happy to address all of them. There's another concept of deemed residency. I'll touch upon that maybe after we go to the next slide, and I'll tell you what the implications are, and then we'll come back to the slide one more time. Chayan, please. Yeah. So primarily in India, the residential statuses are of two types. One, resident, and second, non-resident. Resident is further divided into two categories: resident and ordinarily resident, and resident but not ordinarily resident. To become a resident and ordinary resident, you need to be a resident first, and then you need to have 730 days or more in the preceding 7 financial years, and you need to be a resident in at least 2 out of the last 10 preceding financial years. So then you will end up qualifying as an ROR, and the implication of that is that you are taxable in India on your worldwide income if you end up qualifying as an ROR. The second type of resident is a resident but not ordinarily resident. The implications are more or less the same as that of an NR. Here, the worldwide income is not taxable. The only income that can get taxed over here, which is outside India, which is say if you are outside India, is the income which is derived from a business controlled in or a profession which is set up in India. Only that additional income gets taxed here as compared to a non-resident. But your worldwide income is not taxable here in India. And the third and the last scenario is if you end up qualifying as a non-resident. Here, only your income is received in India, or any Indian sourced income, means which is accruing or arising in India, or which is deemed to accrue or arise in India. Only that is taxable here for a non-resident. If you could move to the previous slide now, Chayan, please. So as we explained, in case of an RNOR, the worldwide income is not taxable. Chayan, last slide, please. Yeah. Now here, the provision that I spoke about, if you are, say, an Indian citizen or a person of Indian origin, and if you spend more than 120 days or more and in India in a given financial year, and 365 days or more in the preceding 4 financial years, and if your Indian sourced income is more than 15 lakh rupees, then you would end up qualifying as RNOR during the financial year. There is another concept, and this is very relevant for our audience in the Middle East. There is a concept of deemed residency, which is not dependent on your physical stay here in India. This concept again was introduced 5 years back in the budget 2020. And at that time, the provision that the government had introduced was that if you are an Indian, it's very important that here the emphasis is on only citizenship and not a person of Indian origin. So if you are not an Indian citizen, then this provision does not apply to you. So if an Indian citizen whose Indian sourced income, means any Indian income, is exceeding 15 lakh rupees in a given financial year, and who is not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria of similar nature. Example, in say UAE, there is no personal tax today. In Kuwait, there is no personal tax today. In say Saudi, there is no personal tax today. Example. Then in that case, this provision becomes applicable to you, and you will be considered as a deemed resident of India. Here again, you will end up qualifying as RNOR and not ROR. ROR is taxable on worldwide income. RNOR is not. So when this provision had come in, there was a huge uproar amongst the section of Indian citizens staying in the Middle East especially. And there were rumors that basically even the worldwide income of these people will get taxed here in India. The very next day after the budget in 2020, the Ministry of Finance and CBDT clarified that the intention of this provision is to target stateless people, basically who hop from one country to the other to avoid paying taxes in any country. And this is not meant to target those people who are, say, who have been staying habitually in the Middle East for n number of years, and in any case, the worldwide income of these people will not get taxed here in India. This is what they clarified. But in the next budget in 2021, when the government came up with their budget, they amended a very key definition of liable to tax, and therein they brought the term liable, which is mentioned here, was not defined earlier, so which led to a lot of different interpretations. But in the next budget, as I said, the government amended, means brought in a fresh definition, and that definition said that liable to tax means that the person should be taxable in that country as per the laws of that country for the time being in force. Means it talks about a situation where tax is payable as of date. Okay. Whether the tax is ultimately paid or not is irrelevant, but the country should levy tax. So here, all our people staying in UAE, Kuwait, Qatar, Oman, all of them fell in the ambit of this deemed residency provision. But again, as I mentioned earlier, you needn't get worried, and you will still not be taxable in India on your worldwide income. But yes, the benefits that are available under the Indian domestic tax laws that are relevant to non-residents, those won't be applicable to you. And this is a very big mistake that I have seen people make. People staying, our fellow Indian citizens staying in the Middle East countries, they make this mistake of filing their returns as that of a non-resident. So that is incorrect. That is incorrect. But all is not lost. As I said, worldwide income will not get taxed. And also, India has negotiated tax treaties with multiple countries. If you end up qualifying as a resident of any of these countries with which India has a treaty, especially I'm talking about UAE, Kuwait, and Saudi. These three countries grant residency to an individual based on physical stay. Like if you are in UAE or Kuwait or Saudi Arabia for 183 days or more in a particular calendar year, they follow calendar year. So then you end up qualifying as a resident of that country, and there are tiebreaker rules that are present in the tax treaties that India has with these three countries. Then in that case, you could get tie broken to UAE, Kuwait, or Saudi Arabia. And in that case, as per the treaty, you will be a non-resident, and whatever benefits are available to a non-resident under the treaty, those will still be available to you. But under the act, unfortunately, you will qualify as a RNOR only. I'll just take a quick pause over here and have any questions that people have.
So I think just to kind of summarize, what I feel is that for people who have just moved or have maybe spent 1 year outside, for them it is very crucial to understand कि आज के दिन वो non-resident हैं कि resident हैं कि deemed residency है.
Correct.
Because if that thing is not clear, then they are probably filing the wrong income tax return and they are paying the wrong taxes. So kahin na kahin, I think because this is a little complicated, what we can probably do is at the end of the slide, we can ask people who would want to understand specifically for their case, because what rahega,
it is a fact.
So they can kind of join in. Ki, बहुत सारे regulations है, तो it might be a little difficult for people to capture very quickly. Largely, I think the takeaway for people is that don't assume कि just because आपने 180 दिन से बाहर रह लिया देश के, तो आप नॉन रेसिडेंट बन गए एंड आपको इंडिया में टैक्स नहीं देना है. आपको रेलेवेंट रेगुलेशन देखना होगा. प्लस you might not be taking some benefits which are a part of the treaty in which country you are staying. So if you want to get your position evaluated, probably you might get a answer कि भाई आपको ये treaty में exemption था, but फिर भी आपने उसको use करके नहीं लिया है, and therefore you're missing out on some benefits which you otherwise might be having.
Correct. And this deemed residency criteria, as I mentioned, is very, very ignored. And I've seen a lot of people staying in the Middle East ignoring this and filing returns as non-residents and claiming benefits, and then notices get issued and then they are caught. So it's better that this is adhered to, and at least from the next time onwards, if you are filing your return as a non-resident, then be mindful of what the implications could be. Yeah. Yes.
Absolutely. Makes sense.
We can move on to the next slide, Chen. Yes. So just here, we have listed down 5 basic heads of income that are applicable. Salaries, if you are, say, earning salary here in India, that is taxable. Profits and gains from business profession, if you are earning any income here in India from any business profession, that is taxable. Income from house property, if you have a property here in India and if you have rented that out, the rental income that you receive is taxable. Of course, there's a deduction available, standard deduction available to the tune of 30% of the rental amount. You get a deduction for the municipal taxes that you pay, and you also get a deduction for the interest that you pay on any loan that you have taken to purchase that property. Again, it is dependent on, means if the property is self-occupied, if you have not rented that out, then also you get a rebate or you get a deduction for the interest that you pay. But of course, it depends on the regime that you choose. There are 2 regimes in India now, new regime and old regime. Then capital gains, of course, you are familiar with the concept of long-term and short-term capital gains. We have one full slide on this. We'll go through that in detail. And then income from other sources, basically income which does not fall under any other head would fall under the head income from other sources. Primarily your interest income, dividend income, etc. would fall under the income from other sources head.
Makes
Next
sense.
slide, please. Yeah, so this is a very important provision for non-residents. For a non-resident, many a times people, what I've seen is they are unaware of the provisions that are applicable to them, and they end up, say, reporting dividends in the iOS schedule under the generic dividends field, and that dividend gets taxed at a flat rate. Gets taxed at the slab rates. Then the slab rate may be, say, either 20% or it may be 30% that is applicable to you. But for non-residents, there is a provision that the tax on dividends you have to pay at the rate of 20%. And for interest, there is no interest. The tax rate is not provided under the Indian tax laws, but there are a lot of treaties that talk about beneficial rate of taxation when it's come to both interest and dividend. So I'll discuss this in a lot more detail when we go to the next slide. Next slide, please. Chayan?
I think there's a delay in loading the slide, Abhishek. Just give me 1 sec.
No problem.
I think he's already moved it, but it's not decent.
Abhishek, you're on mute.
Sorry, I was saying that till the time the slide loads up, just to understand what is happening here is, if people who are NRIs are filing their returns, they are probably paying full tax rate on dividend अगर उनको इंडियन कंपनी से आ रहे तो.
Correct.
जैसे रेसिडेंट देता है वो 32% जो भी उनका है वो 30-32% पे कर रहे हैं.
Correct.
Which is phenomenally higher, but for NRIs there is an exemption जहाँ पे उनको 20% में ही dividend का exemption मिल जाएगा.
For all NRs, there
And
is a flat rate of tax that has been prescribed, and that is 20%. They have to mandatorily pay tax at the rate of 20% if you are getting governed by the Indian tax laws. Yeah.
makes sense.
For
And
interest,
interest is more based on treaty.
correct.
Yeah. Sorry, go ahead, please.
Interest ke liye, there is no specific rate that has been prescribed, barring only one provision where you are getting an interest from a unit of a REIT or an InvIT. Then in that case, there is a concessional rate of 5% that has been prescribed under the Income Tax Act. But there is no other rate that has been prescribed for interest. But for interest, all treaties talk about a beneficial rate of taxation, where predominantly if you are a resident of the overseas country and if you are earning any interest income here in India, provided you are the beneficial owner of that interest, most treaties talk about a rate of, say, 10% to, say, 15%. In some treaties, it is 20% also. But there is a beneficial rate that has been prescribed. And the most important part is that this rate that is prescribed under the treaty, it is an all-encompassing rate. You don't have to pay any surcharge or cess on top of that if you are taking a benefit under the treaty. If you are taking a benefit under the Act, of course, it is subject to surcharge and cess. But if you are taking a benefit under the treaty, that is an all-encompassing rate.
So just to understand this in a more practical sense, say I am a person living in Dubai and I have bought some NCDs or I own some debt, corporate debt in the Indian bond market.
Yes.
And उससे मेरे को interest income आ रहा है. तो
Yes.
आज मेरे को उस पे 30% नहीं देना, मेरे को उस पे 10 या 15% basis मैं कौन से कंट्री में domiciled हूँ और उस कंट्री का क्या टैक्स रेट या क्या टैक्स regime चल रहा है, that is what he has to
That is
pay.
absolutely right.
Makes sense. Perfect.
That is absolutely right. And then we have one more provision, we'll come to that later, which is specific to non-resident Indians.
Right.
Yeah. So we'll discuss that in detail. But yeah, what you are saying is absolutely right. Yeah.
Makes sense. Very clear on this.
Thank you. On this slide, we have just captured the rates that are applicable to individuals. If one were to opt for the old tax regime, these are the rates. Income up to 2.5 lakh rupees is not taxable. Up to 5 lakhs, then it's 5%. 5 lakh to 10 lakh, it's 20%. Above 10 lakhs is 30%. But in the last budget, means which came in February 2025, the new tax regime got significantly changed. The rates were rationalized. Income up to 4 lakh does not suffer any taxation. 4 lakhs to 8 lakhs, it is 5%. 8 to 12, it is 10%. 12 to 16, 15%. 16 lakh to 20 lakh, it is 20%. 20 lakhs to 24 lakhs, it is 25%, and above 24 lakhs is 30%. So you can see that under the old tax regime, a person suffers 30% tax rate just after the income of 10 lakh rupees. It's a progressive rate of taxation. But under the new tax regime, the 30% tax rate kicks in even only after your income breaches the 24 lakhs threshold.
24 lakhs.
Yes. And then if
this is standard for both non-resident and resident, right? पहले जो whatever you were paying earlier is the detail on the left. The 2.5 lakh के नीचे nil, and अभी 4 lakh के नीचे अपने को कोई tax नहीं देना है, and 24 lakh के नीचे there is a tiered slab rate.
Correct.
24 lakh plus everything is at 30%, right?
Absolutely. And this is common for both residents and non-residents. Then we have the surcharge rates under the old tax regime. As you can see, under the old and new, surcharge up to 2 crore rupees is the same. Like 50 lakhs ke upar, it's 10%. Above 1 crore, it is 15%. And above 2 crores, it is 25%.
Right.
In the old tax regime, there is an additional provision that if your taxable income reaches 5 crore rupees, then the surcharge that you pay on your tax will be calculated at the rate of 37%. There is no such provision if you opt for the new regime. Okay. Under the new regime, the highest surcharge rate is 25%. And there is one additional benefit, and that is applicable in respect of income that you the tax that you pay on income under the head long-term capital gains. Okay, any long-term capital gains that you make, whether it is from shares, mutual funds, sale of property, anything, the surcharge rate is capped at a max of 15%. And in case of short-term capital gain, the surcharge capping is at the rate of 15%, but that is limited to the short-term capital gains that you earn on sale of STT paid equity shares and equity-oriented mutual funds and units of business trust. Yeah.
Makes sense. Makes sense.
We can move on to the next slide, please. Yeah. Again, here we have tried to capture. So I'll not get into the details of salary, rental income, and all. What is more relevant from us, from our standpoint, is basically the interest, dividend, and the capital gains related part. So for non-residents, especially, if you have, there are primarily two types of accounts that you have here in India. One is an NRI account, and then one is an NRO account. NRI account is used to park your foreign savings here in India. You can repatriate your, so you can park your foreign income here in India, and that is freely repatriable without any limit. The interest that you earn on an NRI account, that is fully exempt from income tax under the domestic tax laws itself. You don't have to go to the treaty for that. But there is another account which is called the NRO account, which is basically opened or maintained to park your Indian savings. Like if, say, you are staying abroad and if you have any rental income here in India, you have invested in mutual funds or say shares in India, you have to get the dividend on that. And if you have to sell your mutual fund units and all. So for that, NRO account mandatorily needs to be opened, and any interest that is earned on the balance lying in the NRO account, that is fully taxable. There is no beneficial rate that is provided under the domestic tax laws for an NRO. But as I mentioned and what we discussed, you can obviously approach you can seek the shelter under the provisions of the tax treaty, the beneficial provisions of the tax treaty, and you can opt for that concessional rate that is available, provided you are a resident of the overseas country and you are able to submit a tax residency certificate and a Form 10F that you need to mandatorily file. So that concessional rate can apply in your facts. So we have seen a lot of people are not aware of these simple provisions and end up paying higher taxes. So the purpose of basically this session is that people should be familiar with what the law looks like, and if there's anything that they get stuck with, obviously they can reach out to us. But even if they are consulting their own chartered accountant, from the next time onwards, they pay heed to all of these beneficial provisions. Then
Makes sense.
coming to the dividend income, as I mentioned, there is a flat 20% rate that is prescribed for non-residents. And this is for dividends that you get from Indian companies. There is no other rate. You have to mandatorily pay tax at this rate. You don't have the option to pay taxes on slab rates if you are a non-resident in respect of the dividend that you receive. There is another provision that if suppose you have mutual fund investments here in India, and if you have purchased them in foreign currency, then also there are some mutual funds that give you dividend. That dividend is not treated as dividend. It is not treated as similar to dividend that you receive from Indian companies, but for that also there is a 20% tax rate that is prescribed. Okay. Now, similar to the concept of interest, there are DTAAs that talk about a beneficial rate of tax for the dividend also. Like if you are a resident of, say, any country, and if you have investments here in India, then India, obviously being the source country, reserves the right to tax that dividend, but the tax on that dividend will be restricted to the tax rate that is mentioned under that provision. Again, I have seen rates ranging from 10% to 15% to 20%. There are some treaties that talk about a 5% rate also. So one can obviously seek the shelter of these treaties, provided you are a resident of that country, and and you have to obviously take the tax residency certificate on from your local income tax authorities, and you have to file a Form 10F here. And there's a simple one-pager form that does not require application of mind at all. It is a very simple form. Now coming to short-term and long-term capital gains, we have one full slide dedicated to different assets, the holding period that is needed to qualify as long-term capital, to basically qualify as long-term capital assets. What is the tax rate that is applicable to that particular asset? But we wanted to just spend a minute on the DTAA benefit over here, and we again will discuss this in detail when we come to another slide. But for certain specific assets like mutual funds, your debentures, bonds, etc., there is a very, very, very significant benefit that is available under the tax treaty if you have any short-term gain or any long-term gain on sale of mutual fund units or debentures or bonds, etc., that you have here in India, provided you are a resident of the overseas country. We'll spend more time on this in say 5-10 minutes time, but just wanted to touch upon this aspect now. Yeah, we can move on to the next slide, Chair. Go ahead. Yeah. Now here, basically, we have tried to capture what the common pitfalls in relation to the tax return filing here in India are. So one, we have seen people miss out on the return filing deadline. The return filing deadline here in India is 31st July. Your financial year ends in the month of March. 31st March is the last date of the financial year, and then you have 4 full months to file your income tax return. If you file an income tax return after this date, you can file a revised return or you can file a belated return, and you can even revise the original return that has been filed before 31st July or even a belated return, and that can be filed up till 31st of December, and that has to be accompanied with a late filing fee, which ranges from 1,000 rupees to 5,000 rupees depending upon your taxable income. And of course, if there's any tax payable that is to be paid, then there is of course an interest that gets levied along with the tax payable. The updated returns, there is a concept of updated returns also. That updated return can also be filed, and there are additional taxes that need to be paid along when you pay and when you obviously file an updated return, and the updated return can be filed only in certain specific circumstances. Uh, then the common mistake that I've seen, I've spoken about this already, that non-residents cannot file an ITR 1 here in India. So ITR 2 is the basic form that they have to use, provided they don't have any business income here in India. But if they have any business income, then ITR 3 is their go-to form. You should also, when you file your return, uh, pay due cognizance to the entries that are appearing in your form 26AS, AS, TAS. These can be easily downloaded from your income tax e-filing portal, and these entries give you a lot of guidance. But many a times, what happens is that till the date of filing the return, these entries are not updated. So these are just to help you out. These are not 100% sacrosanct. These are just to help you out, but there may be other sources also that are applicable to you. Those may not necessarily be captured in your AIS, TIS, and 26AS. Advanced tax obligations. If you're sorry, Abhishek, you had a point.
No, please go ahead.
Okay, so if your tax payable in India after your TDS, TCS, and all is 10,000 rupees or more, then you have to pay advance tax within the financial year itself. 15% by 15th of June, 45% by 15th of September, 75% by 15th December, and 100% by 15th of March. Failure to adhere to these timelines attracts penal interest. Then, as I mentioned earlier, there are two types of regimes here in India: old tax regime and new tax regime. The new tax regime is the default regime now. For availing of the benefits that are available under the old tax regime, you first need to file the return before the due date. You cannot claim or you cannot avail of the benefits under the old tax regime now if you don't file your return before 31st July. And then there are key deductions. One has to basically make an analysis of whether the old regime or the new regime is beneficial to that person. So not spending too much time on this now, but yes, the choice of regime obviously depends on the fact-specific circumstances of the individual. Indian asset disclosure. If your total income in India is in excess of 1 crore rupees, this limit was 50 lakh rupees till last year, and then for the return forms for FY 24-25, this got updated to 1 crore rupees. Then you have to file a Schedule AL, which is nothing but a schedule of your asset and liabilities here. Specific to non-residents, it will be only the Indian assets. So your Indian assets need to be reported in detail along with your Indian liabilities. Okay, this has to be filled in if your total income is in excess of 1 crore. Then, if you are a non-resident today, but say suppose if you come back to India and you end up qualifying as an RNOR, basically the conditions, the residency conditions that we discussed earlier, to them there is an additional disclosure that applies, which is a foreign asset disclosure. And today this is one of the most critical disclosure that is needed in your return forms. You have to disclose your foreign assets. Of course, there is some leeway that is available in respect of assets up to 20 lakh rupees. But if you are, say, having shares, immovable property abroad, shares abroad, ESOPs abroad, and of course, those ESOPs have been exercised and you've got shares, then all of that needs to be reported here in India. Lower withholding certificate, we have one full slide dedicated to that. So in the interest of time, I'll not discuss it here and spend time when that slide comes. Chen, we can move on to the next slide, please. Yes, so this is the slide that I was talking about when we were discussing capital gains. So these are the updated capital gain rates. This slide captures the updated holding period that is needed for an asset to qualify as a long-term capital asset. So for listed equity shares, equity-oriented mutual funds, units of REITs and InvITs, the holding period to qualify as a long-term capital asset is 12 months now. If you have held it for more than 12 months, it will be a long-term capital asset. And up to gains up to 1.25 lakh rupees here in India are exempt, and any gains beyond that are taxable at the rate of 12.5% without indexation. So earlier, you must be aware that before 2024, before the Modi government came back to power for the third time, there was a concept of indexation. So for this particular asset, indexation was never applicable, but there was a 20% tax rate that is applicable with indexation for some other assets like immovable property, debt mutual funds, etc. But indexation now has been taken away. For these assets, the short-term capital gain rate, if you sell within 12 months, it is 20% plus surcharge and cess. So earlier, your REIT and InvIT units, to qualify as long term, they had to be held for 36 months. And I'm talking about period before July to 23rd July 2024. But the budget that had come in July 2024, that had changed this also. So now even your units of a business trust, REITs and InvITs, those also be held have to be held for more than 12 months to enjoy the long-term capital gain status. Yeah. Then coming to listed commodity ETFs, which is basically your gold ETFs, silver ETFs, equity ETFs. For them, the holding period again is 12 months because those are listed securities. 12.5% is the rate of taxation that applies over here for long term, but the short term capital gain gets taxed at slab rates. Listed tax-free bonds, listed debentures, for them also it's 12 months. Any listed security now, the holding period is 12 months to qualify as a long-term capital asset. 12.5% is the tax rate that is applicable without indexation. Now, and short-term capital gain gets taxed at slab rate. So the 20% rate applies only for equity shares, units of equity-oriented mutual funds, and units of a business trust. Now, debt mutual funds, this is interesting. So debt mutual fund means any mutual fund, if you have acquired it post 1st of April 2023, okay, and this definition also got changed last year. So if your debt mutual fund invests more than 65% of its proceeds in debt or money market instruments, and if you have purchased that after 1st of April 2023, then even the 12.5% rate does not apply. You will get taxed at slab rates. Slab rates are applicable to you in that case. Short-term capital gain and long-term capital gain in that case will not have any difference. But if your mutual fund has been purchased prior to 1st April 2023, then that will continue to enjoy the 12.5% rate that is applicable. So that is not means slab rates won't apply in that case. There is another concept of gold mutual funds. So earlier we discussed gold ETFs. Gold ETFs are listed on the stock exchange, and that is why there is a 12-month period that is available to them. But your gold mutual funds, silver mutual funds, fund of funds, your unlisted shares, which includes the foreign shares, all of this, unlisted bonds and debentures are separate, but your mutual funds, debt mutual funds, gold mutual funds, unlisted shares, for them the holding period is 24 months, and those have to be taxed at a rate of 12.5% if they qualify as long-term capital assets. Short-term, you have to pay tax at the rate of at the slab rates that are applicable to the individual. Unlisted debentures and bonds here in India, this provision again changed last year. So if you are transferring any unlisted bond or debenture here, say as of today, then you have to pay tax at a flat rate. You cannot take a beneficial long-term capital gains rate over here. Slab rates apply to you. Immovable property, the rate that is applicable now is 12.
One question here for unlisted bond and debenture. Irrespective of your holding period, will your cap gain be subject to slab rate only?
Yes, this provision, as I mentioned, changed in the second budget that came in last year once when the Modi government came back to power. So they amended this provision to say that unlisted debentures and bonds, any bonds and unlisted debentures that are transferred, or say if they mature after 23rd on or after 23rd July 2024, they will be taxable at slab rates. Basically, long-term capital gain status नहीं मिलेगा उनको.
Okay, मतलब तो bond कभी भी बेचो आपको slab rate का ही खर्चा पड़ेगा.
Slab rate मिलेगा उसके ऊपर. Now there are some decisions pronounced in the context of some other provisions which are similar provisions, wherein it has been held by the courts that you cannot restrict this and some of the other benefits should be available. But this is a litigative issue. The primary view that is floating in the market, if you want to avoid litigation, is that you pay tax at the rate of at slab rates.
Full
yeah,
value.
But the beneficial provision that is there for the non-residents, we can approach that when we discuss that mutual fund or debenture related provisions. Immovable property, as I said, again, 24 months is the holding period for any property that is sold on or after 23rd July 2024. You have to pay tax, long-term capital gains at the rate of 12.5% without indexation. There is a grandfathering provision that is applicable in respect of properties that were purchased prior to 23rd July 2024. But unfortunately, that grandfathering is available only to resident individuals, not available to non-residents. And the short-term capital gain is taxed at slab rates. And then when it comes to your jewelry, your bullions that you keep in your lockers or at home, or digital gold, for them also the holding period is 24 months. 12.5% rate applies for long-term capital gains, and for short-term they are taxed at a slab rate. So net short-term will always be slab rate unless your short-term capital gains are in the nature of gains that you make after transferring equity shares, equity-oriented mutual funds, or units of a business trust. Yeah. I guess there's some problem with the slide, but meanwhile, if there's any question, happy to answer that, and then we can move on to the next slide.
I think
अभिषेक ये टैक्स रेसिडेंसी सर्टिफिकेट जो रहता है,
हाँ जी.
nowadays people in Gulf countries, they take that certificate and they had some exemption. What is that? How it is?
Yes. So exemption आपको मिल सकता है depending upon the nature of income. There are 2-3 types of benefits that are applicable. One is 100% exemption from the relevant income here in India. वो सैलरी का भी हो सकता है, वो कैपिटल गेन्स का भी हो सकता है, एंड कैपिटल गेन्स में कुछ कुछ चीजों का हो सकता है. We'll discuss that in detail. As I mentioned while we were discussing one of the earlier slides, there is a beneficial rate that is available in respect of dividends and interest in certain treaties. So instead of paying tax at a full slab rate, you can pay tax at the rate of say 10% or 15% or 20% if you are a resident of the overseas country and you are receiving interest or dividend from say an Indian company. Okay. So then in that case, आपको वो beneficial rate avail of करने के लिए आपको वो tax residency certificate apply करना पड़ता है. आपको रिटर्न के अंदर डिस्क्लोजर करना पड़ता है. टैक्स रेजिडेंसी सर्टिफिकेट आपके पास है उसका. देयर इज अ स्पेसिफिक शेड्यूल दैट यू नीड टू फिल इन दैट एंड आल्सो अलोंग विद दैट यू हैव टू फाइल अ फॉर्म 10F एंड उसमें आपको फॉर्म 10F फाइल करते टाइम यू हैव टू अपलोड योर टैक्स रेजिडेंसी सर्टिफिकेट. TRC आपको अपलोड करना पड़ता है एंड देन योर डिस्क्लोजर इज एंटायरली कंप्लीट. एंड दिस इज वेरी इंपॉर्टेंट बिकॉज जब आप ये वाले बेनिफिट्स लेते हैं, डिपेंडिंग ऑन द क्वांटम ऑब्वियसली, there is a good chance that the authorities may ask questions, may issue you a scrutiny notice, etc. But as long as you have everything on record, your claim is, you can substantiate your claim by way of proper document trail, treaty के अंदर वो clearly covered है, you needn't get worried at all. And it's a very simple process to get a TRC. It takes time depending from country to country. But आजकल UAE में तो it's available in a span of a month. Easily मिल जाता है एक month के time.
Okay, thank you.
Next slide. Yes.
I think
So
before we hop on to this is one of my favorite slides. This is a very interesting provision that I don't think even 1% of the NRIs would also be aware of. So I'll obviously let Abhishek cover it, but I just want to kind of give a quick this thing that people should be very focused on this next 5 minutes. It is very interesting.
Thank you, Abhishek. Yeah. So this is a provision that is applicable to NRIs. All this while I have been talking about NRs, but this provision is applicable specifically for NRIs. What do you mean by an NRI first? We'll just spend 15 seconds on that. NRI means a person, one, who is a non-resident. Okay. And that non-resident is either an Indian citizen, okay, or he is a person of Indian origin. What is meant by a person of Indian origin? That person, either he or either of his parents or any of his grandparents should have been born in undivided India. So if that person qualifies this or satisfies this norm, then that person becomes a person of Indian origin and this provision becomes applicable to them. So if that non-resident Indian makes an investment in India using convertible foreign exchange and invests into certain specified assets, and what are those assets? Those assets are shares of an Indian company, any Indian company. It can be private, it can be public, it can be listed. Means there are unlisted public companies also. That's why I mentioned public companies separately. Shares of any company here in India, or if he purchases debentures of an Indian public company, or say deposits money with an Indian public company. Here, the word public is relevant. For shares, it is not relevant. So if you invest in specified assets, then you are entitled to certain specified benefits. One condition, you should be NRI. Second, you should purchase specified assets. Third, you should purchase these assets in convertible foreign exchange. If you are purchasing this using Indian currency from the balance lying in your Indian accounts, this special chapter is not applicable to you. Now, for these people, there is a special type of taxation that is applicable for any investment income that they derive from these assets, specified assets, say dividend that you get from the Indian companies, or say the interest that you earn on your debentures and deposits, or say central government securities. Then that dividend or interest is taxable at a flat 20% rate. Flat 20% rate. Then another provision is that long-term capital gains, there is no, because now the rates have been rationalized and there is only one long-term capital gain rate now. Earlier, this rate used to be 10%. Now, to rationalize it and to streamline this with the other provisions of the Act, they have made this 12.5%. But I'll come to the long-term capital gain related benefit in say the next 1 minute. So you can pay long-term capital gains at the rate of 12.5% in relation to the gains that you make on transfer of these specified assets. You don't get any Chapter 6 deduction like ATC, ATD, etc. You will not get against this income. Okay. Now, the most important provision here, if you have any long-term capital gains on sale of, say, we'll talk about shares specifically, just to take an example. If you have invested, say, your specified asset is share in an Indian company. If you have made a long-term capital gain on that share, okay, if you reinvest the money that, and not just the gains, the consideration that you have received on sale of that particular share, if you reinvest that money into another specified asset within 6 months, then that gain will be exempt depending on the amount of investment. Say, suppose if the entire sale consideration is reinvested in another specified asset, the entire long-term capital gains will be exempted. If you say invest only a part of the sale consideration, you will nevertheless get a proportionate benefit. But the good part is that by putting money in another specified asset within 6 months, you are getting this benefit. So means earlier or in any other case, the people used to purchase house property, etc. There is a 54F benefit that you get against long-term capital gains, and for that you have to purchase a residential house property. But all of that can be avoided if you are reinvesting the same proceeds in another specified assets within the required time frame of 6 months. And then you have to hold that reinvested asset, the new asset, for a minimum period of 3 years. If you sell that reinvested asset within a period of 3 years, then the capital gains that was not taxed earlier will be deemed as capital gains in the year in which you sell that new asset. So this is again a wonderful provision. This is a specific provision for non-resident individuals. I'm in my interactions with various non-residents that I have dealt with, I can tell you that 99 out of 100 people were not aware of this provision. And this is a provision for which you don't even have to access the treaty. This is a provision which is available under the Act itself. Also, if suppose you don't have any other income, like this is your only source of income here in India, then even there is no return filing requirement for you. For the investment income especially, not for capital gains, only the investment income. Tomorrow, if you become a resident here in India, then you can still avail of the beneficial rate of 20% that is available. Of course, that will not be available for the capital gains that you make, but for the investment income like dividend and interest, that will still be available. And obviously, this is not a mandatory chapter. You can means this is optional. If you feel that the provisions of DTAA are more beneficial to you, or say any other provision within the Act is more beneficial to you, there is no hard and fast rule that you have to opt for this every year. You can opt out easily. That's not applicable. You just have to make a simple disclosure in your return form. But the disclosure to avail of this benefit is extremely critical in the first section of the return form and in the capital gains and in other sources schedule.
So just to understand this with a practical example, say I'm a person who's living in Dubai for that matter,
Yes.
and I transfer some money from my foreign account to my NRI account and from my NRI account to my NRO account.
Yes.
उस NRO अकाउंट से मैंने 10 करोड़ रुपए का NSE का शेयर खरीद लिया.
Yes.
अब मैंने जब वो शेयर खरीदा, that time the price for NSE was 1,000 rupees. 5 years later, it is now at 5,000 rupees.
Yes.
Now, if I am selling that share of NSE and within 6 months, जो भी sale proceed आया, if I'm investing into another Indian company, whether it be listed or unlisted,
Yes.
my tax is zero for the moment.
Yes, that is correct.
Wow.
But you will have to hold the new asset for a minimum period of 3 years.
Minimum of 3 years. Minimum
Yes.
of 3 years.
Yes.
So this is a very interesting perspective. जिसको Indian market में ही invested रहना है. For him, this is a game changer clause. He can stay invested for the next 20 years without ever needing to pay a single penny of tax to the Indian government.
Correct.
He can.
And here TRC and all is also not important. Here the overseas residency is also not important. आप overseas country में resident हो या ना हो, it does not matter because this is a benefit under the act.
Wow. And how does one claim this benefit? Does he simply in the ITR kind of tell that this is the 115E benefit that I'm taking?
Correct. This is
Therefore my taxes should be kind of neutralized under this.
You first have to opt in the first section of the form in your basic details. There is a checkbox that is available. And then you have to make the relevant disclosures in respect of capital gains in the capital gains schedule and the relevant disclosure in respect of the interest income or dividend income in the other sources schedule.
Brilliant, brilliant. I think this is a very interesting concept which will meaningfully help a lot of people on the call because largely all of the NRIs who are on the call would have some investments into India on which probably they are paying taxes when they are selling the investment. But if they are reinvesting it within 6 months and the reinvested asset they are holding for 3 years, then they are actually free from any tax on their previous gain.
That is
this can be a brilliant tax planning tool for people who are not aware of this.
One simple condition that you have to mandatorily purchase this asset in convertible foreign exchange.
Convertible foreign currency. आपको बाहर से डॉलर का जो भी अपना
source is very important. Yeah.
INR बनाना है, NRI में NRI से NRO में डालना है, फिर NRO से जो इन्वेस्टमेंट करना है कर लो. फिर they can obviously repatriate NRO से, they can again take the money back into NRI up to $1 million a year.
NRO से NRI बहुत बैंकर्स परमिट नहीं करते, बट NRO से आप डायरेक्टली ओवरसीज बैंक अकाउंट में $1 million तक एवरी ईयर भेज सकते हो.
नहीं जा सकते, and that is also not subject to any tax.
No, that is your own. वो tax paid money रहता है ना. That is one's own tax.
money है ना. मैंने जो भी asset है, मैंने asset बेच के जो भी tax बना देखिए किया.
There are bankers who will insist on filing of your basically 15 CACB form. वो होगा. But predominantly compliance करना पड़ेगा.
Doing the compliance.
And NRI से NRI तो it can be repatriated without any limit. NRI to overseas.
Makes sense. Isme, we have a couple of questions. Is it okay if we just take this?
Yeah, please. Let us go ahead. Yes.
One question with received is, if I sell my central property in India and sell it, I reinvest it in shares, will I get the benefit?
नहीं, इसमें the asset that needs to be sold can only be a specified asset, which is, as I mentioned, shares of an Indian company, debentures of an Indian public company. Now your deposits and central government securities भी है, but वो इतना easily transfer नहीं हो सकते. Deposits cannot be transferred. हाँ. So अगर आप shares, if the underlying asset is an Indian share, be it private or be it of a listed company or public company, and debentures of a public company, अगर आप वही sell कर रहे हो, तो आप तो ही ये benefit मिलता है. Otherwise, you will not get this benefit.
We're getting a lot of queries on sale of property. So another person is asking, if I sell my ancestral father's property, is there any way to kind of save taxes on that?
Yeah, there is, but that benefit is available under a different chapter, capital gains chapter में. You will have a section 54 benefit or a 54 EC का benefit, where if you purchase another house property or if you invest in say NHI or REC or PFC के bonds आते हैं, उसमें यू गेट अ बेनिफिट. वो 54EC का बेनिफिट इज कैप्ड एट 50 लाख रुपीज. बट फॉर अ प्रॉपर्टी, अगर आप एक नई प्रॉपर्टी लेते हो विद इन द टाइम फ्रेम दैट इज प्रिस्क्राइब, विच इज 1 year बिफोर और 2 years आफ्टर, और इफ यू कंस्ट्रक्ट अ न्यू प्रॉपर्टी विद इन 3 years फ्रॉम द डेट ऑफ ट्रांसफर, देन आपका वो रेजिडेंशियल प्रॉपर्टी का कैपिटल गेन्स इज नॉट टैक्सेबल.
सो जस्ट टू समराइज फॉर द ऑडियंस, अगर आपके पास शेयर या बॉन्ड या डिवेंचर है तो आप उसको बेच के वापस से शेयर और बॉन्ड और डिवेंचर खरीदते रहिए, और आपको कोई कैपिटल
बॉन्ड्स नहीं है, सिर्फ डिबेंचर्स है.
डिवेंचर्स. एंड अगर आपके पास प्रॉपर्टी है और आप प्रॉपर्टी सेल कर रहे हो तो आपको नई प्रॉपर्टी या जो 3 REC बॉन्ड, NHI बॉन्ड, जो भी होती है, उसी में आपको डालना पड़ेगा. सो आई थिंक Dinu ji, just to answer your question, if you're selling property in India, you'll have to reinvest into property or the 3 mentioned assets. आप उसको शेयर में नहीं लगा सकते हो. And similarly, Dilal ji, आपका भी जो same question था, largely property, if you're reinvesting that, will have to get into a property only.
उल्टा परमिसिबल है. अगर आप शेयर सेल करके प्रॉपर्टी लेते हो तो एक और प्रोविजन
that is obviously
54F में अवेलेबल है, बट उसमें आपको प्रॉपर्टी खरीदनी पड़ती है. बट हम वो अवॉइड करने के लिए बोल रहे हैं, आप दूसरा शेयर ही ले लो तो आप आपका लॉन्ग टर्म.
हाँ, मोबाइल है. राइट, एब्सोल्युटली. एक क्वेश्चन ले लेते हैं सुरेश जी, इफ यू वुड वांट टू आस्क.
Abhishek, what if I sell these specified assets in March and my deadline for filing the return is 31st July, तो 6 महीना वहाँ नहीं, तो फिर how I can escape, माने उसको मैं कैसे रिप्रेजेंट करना है ITR में. मार्च में मैं सेल करता हूँ और जुलाई तो मेरा रिटर्न फाइलिंग आता है, तो 6 महीना नहीं होता है. मे बी आई इन्वेस्ट इन अगस्त, तो फिर उस टाइम रिटर्न फाइल करते वक्त कैसे हाउ आई टू रिप्रेजेंट कि भाई मैं लगाने वाला हूँ.
फेयर क्वेश्चन सर. सो इसके लिए ना, अगर मैंने इसके पहले जो 54 और 54F का एग्जांपल दिया था, उसके लिए ना गवर्नमेंट का एक कैपिटल गेन अकाउंट स्कीम का एक कॉन्सेप्ट है. ठीक है, दैट सिमिलर प्रोविजन इज नॉट एप्लीकेबल ओवर हियर. सो ये बहुत इंटरेस्टिंग चीज है. तो यहाँ पे क्या होता है, अगर सपोज आपने अगस्त में किया है ये वाला चीज, तो आपके पास दिसंबर तक टाइम रहता है टू रिवाइज योर रिटर्न. ठीक है, यू कैन इजीली रिवाइज योर रिटर्न एंड क्लेम द नेसेसरी बेनिफिट. आपने अगर ओरिजिनल रिटर्न में नहीं दिखाया, या अगर आप अपना टैक्स पे करके दूसरे सोर्सेज से जो आपकी इनकम है, आप अगर बिलेटेड रिटर्न में भी क्लेम करते हो, तो देयर इज नो हार्ड एंड फास्ट रूल ओवर हियर दैट यू नीड टू नेसेसरली फाइल योर रिटर्न विद इन द ड्यू डेट टू क्लेम दिस पर्टिकुलर बेनिफिट. तो आप वो ले सकते हो. या आपको अगर इंटेंडेड भी है वो लेना, अगर आपको पता है कि आपको लेना ही है, तो बेस्ट तो वो होगा कि अगर आप कंप्लायंस वो 4 months के अंदर ही कर लो, अगर आप ओरिजिनल रिटर्न में क्लेम करना चाहते हो. और अगर नहीं कर सकते तो यू कैन क्लेम दैट इन बिलेटेड रिटर्न और रिवाइज रिटर्न. इसमें कैपिटल गेन अकाउंट स्कीम का कॉन्सेप्ट डज नॉट अप्लाई, व्हिच इज एप्लीकेबल इन केस ऑफ हाउस प्रॉपर्टी
listed.
यस.
Okay, thank you.
Thank you, sir. One question we got on is, I bought shares in unlisted markets from my NRO account with NRI funds. Can I repatriate the proceeds back to NRI? How can I prove that the source of funds was NRI after many years?
So if वो सोर्स आपको एस्टैब्लिश करना पड़ेगा. वन, टुमारो इफ देयर इज अ स्क्रूटनी, आप बेनिफिट ले लो, एंड इफ सपोज देयर इज अ क्वेश्चनिंग एट अ लेटर पॉइंट इन टाइम, you will have to prove that these funds were primarily sent from abroad. They were sent to your NRE account and then sent to your NRO account, and from there you purchase the asset. NRO to NRE bankers in most cases do not allow. NRE to NRO आराम से हो जाता है. NRO से वो NRE में परमिट नहीं करते, बट NRO से you can take the money directly abroad, $1 million तक, जो आपका प्रिंसिपल अमाउंट है. Okay, that you can easily take abroad, $1 million तक. तो the time gap does not matter. What matters is that you should be able to establish that this
paperwork.
Yeah.
आपने जो original RTGS करके NRO को फंड किया होगा ना, Jacob, so you'll have to ensure that you have the bank statement from your NRE account wherein you had made the first RTGS or you had cut the first check, so that you can prove that this funding to the NRO account was from the NRE account. And to answer your first question, what Abhishek had clarified is NRO to NRE is difficult, but आप overseas bank account में directly ले जाओ, उसमें कोई problem नहीं है. Subject to the $1 million.
Some bankers don't allow, but technically it is possible to transfer from NRO to NRE. Yeah, it is possible. NRE to NRO, no problem. NRO to NRE is also possible, but some bankers tend to basically follow a conservative path and they allow. Foreign banks usually, जो Citi होता था पहले, HSBC, your Deutsche Bank, they clearly permit NRO to NRE also.
That's right. So I think Lalji is giving a feedback कि उन्होंने काफी time किया है NRO to
Yeah, it
NRE.
is possible, yes.
ICICI, HSBC and IDFC
HDFC में major problem आता है, कोटक में आता है.
वो national banks disallow कर रहे हैं,
Yes.
लेकिन private banks largely are okay with this.
That is right.
All right. So I'll take another 10 seconds अगर ये specific clause पे कोई भी question है, because this is a very interesting aspect which we felt that it deserves more time and attention. If not, then we will move to the next slide. Got it. I think we are good. We should move ahead.
Sure. Now, this is another provision that, in my experience, and I specifically wanted to discuss this one particular aspect over the course of this webinar, is a lot of non-residents hold immovable properties here in India. Okay. So what happens is that those non-residents, when they have to sell the property, so the buyer, on what amount should the TDS be deducted by the buyer? Okay. Now, for resident individuals, when the seller is a resident, there is a clear section. That section says that if a buyer is paying sale consideration to a resident, and if the consideration is greater than 50 lakh rupees, at 1% pay, you deduct the TDS. Okay. There is no such provision for payments to be made to non-residents. Okay. So the law says that if you are purchasing property from a non-resident, you have to deduct taxes as per the rates in force on the amount which is chargeable to tax. Now, how does the buyer get to know what is the amount chargeable to tax? So buyers क्या करते हैं, in the absence of any information, वो depending on the type of gain, whether short term है, तो वो जो slab rate रहता है, वो 30% plus surcharge plus cess पे TDS काट देंगे of the entire sale consideration. या अगर से लॉन्ग टर्म कैपिटल एसेट है, वो तो इजीली एस्टैब्लिश हो सकता है परचेज डीड देख के, जो पुराने बायर के पास परचेज डीड है वो देख के एस्टैब्लिश हो सकता है कि ये लॉन्ग टर्म एसेट है कि शॉर्ट टर्म एसेट है. सो दे डिडक्ट टैक्स एट द रेट ऑफ से 12.5% और एट 30% प्लस सरचार्ज प्लस सेस ऑफ द एंटायर अमाउंट. बट आपको टैक्स तो अल्टीमेटली यू हैव टू पे ऑन द कैपिटल गेन अमाउंट विच विल बी सेल माइनस कॉस्ट ऑफ एक्विजिशन और कॉस्ट ऑफ इम्प्रूवमेंट. ओके. So in that case, what we suggest to our clients is that you approach the income tax authorities for what we call as a lower withholding certificate. It is a section 197 ka certificate. You approach the tax authorities. It is an online form. You need to fill in that form in detail. You have to upload your draft computation of income along with that. Based on that, the income tax department will issue you a certificate within say 2 to 4 weeks. And wo certificate you can give to the buyer. Okay. उसमें the percentage that is mentioned is a percentage of your total sale consideration. तो हो सकता है आपका gain का amount जितना amount आ रहा है, that is actually 2.5 or 3% of your total sale consideration. So the buyer has to then mandatorily deduct the tax at that rate. There is no option for him to deduct tax at a higher rate. So this leads to a lot of say initial cash lockup, because otherwise, say if you are selling your property in April or May of a financial year and वो TDS काट लेता है आपका एक higher rate पे, तो आपको अगले जुलाई तक you have to wait to file your return and to claim a refund in that account. Okay. उतना amount का. Instead of this, you apply for a lower withholding certificate and get your taxes deducted at a lower rate or the applicable rate and avoid a cash lockup. This is the best and most effective way that I have seen to avoid initial cash lockup. There are other ways like आप refund के लिए wait कर सकते हो, या some sellers also approach a local chartered accountant and ask that chartered accountant to issue a certificate कि मेरा gain इतना है. But we have seen that the buyers are in where the amount involved is significant. They are a bit hesitant to rely on that CA certificate कि इसकी sanctity क्या है क्या नहीं है. So इसलिए lower withholding certificate from the income tax authorities is the best way out, most efficient way out, and it avoids initial cash lockup. Any question over here? Pretty easy to get that. Any question over here? All right, we can move on to the next slide. Sorry, Abhishek.
What a question who's Dalal is asking. What if we don't do it? As in,
Don't
I'm
आप
टीडीएस फिर आपको ज्यादा कटेगा सर, और क्या है?
टीडीएस ज्यादा कटेगा एंड आपको, हाँ तो फिर एज आई मेंशन लोअर आपको, देन इन दैट केस यू विल हैव टू फाइल, यू विल हैव टू वेट टू फाइल योर रिटर्न टू क्लेम द रिफंड। देन रिफंड उतना टाइम अटका रहेगा आपका।
मतलब आपको साल भर के लिए हो सकता है टैक्स ज्यादा दिन लटका के रहना पड़ेगा, बाकी अदरवाइज कोई लॉस नहीं है। इट इज ओनली अ टाइमिंग डिफरेंस, दैट इज इट।
सर बायर 1% टीडीएस नहीं करेगा इसमें। बायर का 1% टीडीएस अप्लाइज ओनली व्हेन द सेलर इज अ रेजिडेंट। व्हेन द सेलर इज अ नॉन रेजिडेंट तो 1% टीडीएस रेट डज नॉट अप्लाई। इट डज नॉट अप्लाई टू नॉन रेजिडेंट्स। अगर बायर ने कर दिया है गलती से 1% तो वो उसका हेडेक है, उस पर कल को जाके डिपार्टमेंट कैन इनिशिएट प्रोसीडिंग्स फॉर शॉर्ट डिडक्शन ऑफ टैक्स एंड उससे रिकवर कर सकता है अलॉन्ग विद इंटरेस्ट एंड पेनल्टी।
ओके, एंड अगर आपने
Aware से,
उसके
अगर
बाद
आपके केस में
इमीडिएटली आपने उसके बाद इमीडिएटली अगर टीडीएस उसका अकॉर्डिंगली जमा कर दिया, मतलब एज एन एडवांस टैक्स, देन डज दैट हेल्प और इट्स जस्ट इट डजंट हेल्प एट ऑल?
नहीं, एडवांस टैक्स तो सेलर डिपॉजिट करेगा ना, बायर तो नहीं करेगा ना। बायर ने 1% टीडीएस करेगा ना, तो उसका तो
अच्छा,
टीडीएस।
सेलर ने बताया ही नहीं कि वो एनआरआई है। हाउ कैन द बायर नो कि ही इज एन एनआरआई?
तो फॉर दैट यू ऑब्वियसली हैव टू फर्स्ट कंसल्ट। तो यही तो बेसिक प्रोविजन, बेसिक हमारा सेमिनार का, ये आज वेबिनार का पर्सपेक्टिव वही है कि व्हेन यू आर परचेसिंग प्रॉपर्टी यू फर्स्ट नीड टू अंडरस्टैंड और फर्स्ट नीड टू फाइंड आउट दीज बेसिक थिंग्स। कि पहले तो उसका रेजिडेंशियल स्टेटस पूछना चाहिए, आपने उसका 2 साल का रिटर्न मंगाना चाहिए कि उसने कैसा फाइल किया है, वो कहाँ पे सिचुएटेड है। बहुत बार क्या होता है, जो एनआरस रहते हैं ना वो टिपिकली इंडिया आते भी नहीं है प्रॉपर्टी बेचने के लिए। दे गिव अ पावर ऑफ अटर्नी टू वन ऑफ देयर रिलेटिव्स और वन ऑफ देयर फ्रेंड्स हियर इन इंडिया, एंड वो पावर ऑफ अटर्नी एक्टर उनके बिहाफ पे वो पूरा कंप्लायंस करता है। सो ऑल दीज आर स्मॉल स्मॉल थिंग्स दैट यू हैव टू बी विजिलेंट अबाउट when you are deducting the TDS, because the onus is on the buyer to deduct the TDS. So buyers इसलिए ना नॉन रेजिडेंट केस में दे आर ओवर कंजर्वेटिव, वो ओवर कंजर्वेटिव करके वो लोग हायर टैक्स डिडक्ट कर देते हैं, which is why this lower withholding certificate is very important from a seller standpoint.
Okay.
If there are any other questions that you have, we can discuss that offline. Yeah.
सर एक क्वेश्चन है, कैन आई इन्वेस्ट प्रोसीड्स ऑफ एंसेस्ट्रल प्रॉपर्टी अमाउंट एंड शेयर विद माय सन आफ्टर पेइंग कैपिटल गेन्स टैक्स? So I think Venu ji wants to ask if he sells a property which is in his name, and he invest in the money in his son's name.
तो सेक्शन 54 का एग्जेम्पशन मिलता है नहीं मिलता है? Is that the question?
Is that the question? आप ऐसा पूछना चाह रहे हो? नहीं, वो लिख रहा है कि I am okay paying the tax.
हाँ कर सकते हैं, कोई दिक्कत नहीं है।
टैक्स देने के बाद तो आप कर सकते हैं सर, टैक्स तो
कोई दिक्कत नहीं है सर, एक बार गवर्नमेंट को टैक्स मिल गया तो प्रॉब्लम नहीं है। बट देयर इज, while this does not come from the act, there are a lot of tribunal decisions which and even high court decisions wherein it has been held that अगर आप सेल कर रहे हो and if you are purchasing the property in your son's name or in your daughter's name, that is also allowed। आपको कैपिटल गेन भी देने की, टैक्स देने की भी जरूरत नहीं है, आपको सेक्शन 54 का बेनिफिट मिल जाएगा। What is important is that you should reinvest the money. It's not important कि आप किसके नाम पे ले रहे हो। So this does not come from the act. This is based on an inference that we draw from judicial precedents, favorable judicial precedents.
But again, this is one of my most interesting slides. So again, all yours, please. So a lot of people.
Abhishek, just one moment. For this last question, is there any need for gift deed?
नहीं, गिफ्ट डीड का तो इसमें बात नहीं होगी, बिकॉज आप फर्स्ट टाइम पैसा ही परचेस, आप फर्स्ट टाइम प्रॉपर्टी उनके नाम पे परचेस कर रहे हो, तो गिफ्ट का तो कुछ हुआ नहीं। हाँ, अगर आप सपोज जो आपको प्रॉपर्टी से पैसा आया है वो आप गिफ्ट कर रहे हो टू योर सन एंड देन यू आर से सन के नाम पे आप प्रॉपर्टी ले रहे हो, तब गिफ्ट डीड करनी पड़ेगी। बट अगर डायरेक्ट परचेस कर रहे हो इन योर सन्स नेम, देयर इज नो डीड फॉर गिफ्ट डीड ओवर देयर। बट फॉर जनरल गिफ्ट ट्रांजैक्शंस विद इन फैमिली, मैं एक जनरल कॉन्सेप्ट बता रहा हूँ, इट इज वेरी इंपॉर्टेंट दैट आप गिफ्ट डीड बनाओ, बिकॉज अगर वो बहुत हायर अमाउंट है आपके इनकम, आपके बैंक अकाउंट में, दैट इज गेटिंग रिफ्लेक्टेड, तो इट इज ऑलवेज इंपॉर्टेंट दैट इट इज सब्सटेंशिएटेड बाय वे ऑफ अ गिफ्ट डीड, क्योंकि कल को जाके वो अगर केस स्क्रूटनी में आता है तो देन यू कैन इजिली प्रूव दैट देखो हमने तो गिफ्ट डीड बना के पूरा किया था। बट नॉट फॉर दिस पर्टिकुलर फैक्ट पैटर्न दैट वी वर डिस्कसिंग।
Just another question. If, for example, I sell the property, and if I buy in my daughter's name or son name, I will do the payment and it will be in the daughter's name.
That is right.
And it will be tax exempt free if it matches the capital gain requirements.
That is correct. But there is no guarantee that the lower level authorities will not scrutinize it. There is no guarantee that the lower level authorities will approve of it. But if this case goes into litigation, yes, this is defendable. There have been favorable judicial precedents in the past where the courts, the tribunals have taken a view that एक family member के नाम पे purchase हो रहा है, as long as the money is getting reinvested, the capital gain is getting reinvested, it should be okay. What matters is the money that what matters is the money that is getting reinvested and not the person in whose name it is getting purchased. But better है आप अपने नाम पे करो ताकि लोअर लेवल पे लिटिगेशन भी अवॉइड हो. खुद के नाम पे परचेज करके लगे तो बाद में गिफ्ट दे दो. बट दूसरे सर्कमस्टेंस में भी डिसीजंस हैं.
Okay.
Yeah.
Makes sense. Very helpful.
ये बहुत इंटरेस्टिंग टॉपिक है 54F. There are a lot of questions that I typically get whenever I take this kind of a session on 54 and 54F only. Minor में clubbing होगा नहीं होगा. So all of these are very important.
Makes sense.
Yes.
Just sorry, one last question regarding this. Is it applicable only to the first two properties or all properties? Residential properties.
So the residential property के लिए 54 में there is no condition that आपका say you need not hold any other property या say you should not be taking this property. For 54F, when you sell asset which is other than a residential house property, in that case there is a requirement that you should not own more than one house properties on the date of transfer. Okay, other than the new asset. But for this, there is no such requirement. Section 54F, Section 54 mein there is one provision that if your capital gains for the first two वगैरह का there is no such concept. But say suppose your capital gain is say around 2 crores, then the law says that you can invest in one house property here in India, reinvest the capital gains. So instead of one, you can invest in two, but your capital gain ka exemption is capped over there.
What about if we buy the property on wife name after selling this
You
family
can buy
property?
It's not that ki son ke naam pe leni. You can buy it
Wife
in the
also.
wife's name also. But as I said, ki this does not come from the Indian tax laws. This is supported by favorable judicial precedents. So there is no guarantee that the lower level authorities will not litigate this matter. There's a fair chance that you may get a notice. You will have to substantiate this. There is a fair chance that the income tax officer may not agree also. But you'll have to fight it out. Eventually, you'll get the benefit at a, say, CIT appeal level or tribunal level. But better to avoid. If you have to do this, it's better you purchase in your name and then gift the property by way of a gift deed.
But for the gift deed also, there is a 3% some taxes, some
Yeah, there
service
is
taxes are there.
stamp duty. Stamp duty.
Stamp duty. So
That
this
depends from
3%.
state to state. No, that depends from state to state. The state in which the property is situated. Stamp duty is
And that is depends upon the property value, right? Registration
Correct.
value.
correct.
No,
So
some states have flat rates, like Haryana is probably 10,000 a flat rate.
Okay.
Got it. Okay, so I think in the interest of time, let's get to the next two slides. And gift we will probably cover in another presentation because that in itself is a very, very long this thing.
yeah, sure.
I did not cover it here. एक दो question है if you allow me this.
Yeah, no problem. We can do that, no problem.
I think one question we received from Mr. Ravi is, can I send money from NRI account to my resident father to buy farmland on his name? Is gift deed needed in such a case?
See, NRO se NRO mein you can transfer. NRI se resident, again you will have to check with your banker. I don't see any challenge because the money is still in India. So I don't see that as a challenge, but it depends from the say the comfort will have to be taken from the banker over here.
So the ideal route is NRI to NRO and NRO to father's account. Yeah.
Yes, that's right. That's the ideal route. Because the
One
purpose of
question.
an NRI account is different.
So it makes sense. Absolutely. One question was on taxation from Mr. Chetan. He's put it twice, I guess. He wants to understand, Chetan, if you want to kind of clarify what your exact query is so that we can answer a pointed question. Chetan ji, if you're on the call, if you could kindly. I don't think he's able to answer, but yeah. So I think query was TDS on AIF essentially, and I think he just want to understand AIF taxation for a foreign investor, as an NRI.
Okay. Should we spend time on that over here, or maybe in the interest of time, we'll just.
Yeah, I think we can take it one on one. So I think we can ask him to connect with us, and then we can take it.
Perfect.
Because
Sure.
I think itself, I'm assuming it's a
Yeah. So
it's a chunk. Makes sense. Okay. So I think let's go ahead with this slide.
sure. So this is So this is a very important concept again, and treaty exemption on mutual fund capital gains. So the idea here is that a lot of treaties that India has with other countries, and not all treaties basically have this provision. Okay, but some treaties, and we've captured some of those names in the in this slide. So treaties with Singapore, UAE, Mauritius, predominant European treaties like Germany, France, Netherlands, Italy, Spain, Switzerland, Ireland, and your Asian countries such as Japan, Singapore, Malaysia. The treaties that India has in place with these countries, they have a residual capital gains clause wherein if you are a resident of that particular country, say Singapore, Mauritius, Germany, Ireland, etc., and if you have capital gains from assets which are not listed in any of the clauses that are covered in that capital gains article. And the capital gains article predominantly talks about immovable property, shares, aircrafts, ships, mutual funds, debentures, bonds, etc. are not captured in the capital gains article. So there is a residuary clause which is either 13.5 or say 13.6 or 13.4 in some treaties. So in that article, if you are a resident of the overseas country and if you have mutual fund investments here in India or debentures here in India or say even bonds in India, any capital gains that arises on transfer of these assets, that can be short term, that can be long term, it can be capital gains in relation to debt mutual funds, it can be capital gains in relation to equity mutual funds. That capital gains will be taxable only in the country where the person is a resident. That means in Singapore, Mauritius, UAE, Germany, France, Singapore, etc. That capital gains will not be taxable here in India. It will be straight away exempt. There is a proper disclosure that will have to be done here in the India tax return. For this, mandatorily a TRC will have to be procured from the overseas jurisdiction. A Form 10F will have to be filed. Here, what is relevant is the overseas residency. इसके पहले in the previous slide we had talked about certain assets where the source was important. That asset should have been purchased in foreign currency. Here there is no such requirement. Here the only requirement is that you should be a resident of the overseas country at the time of sale. There are some treaties like the treaty where it says that you should not sell, you should not derive any capital gains within 4 years from the date you become a resident of the overseas country. Okay, means if you were a resident of India and you have become a resident of Sweden now, for 4 years, if you have any such capital gains, then the exemption will not be available. But 99% of the treaties don't have this provision. Okay, so UAE residents, your Kuwait residents, Singapore residents having income from sale of mutual fund units here in India, units of a business trust, bonds, debentures, that entire capital gains can be claimed as exempt here in India. And this is an established position. There are favorable judicial precedents. Very recent two decisions we have highlighted on this slide. There are a lot of other decisions as well, but just wanted to highlight the recent decisions. And these have been pronounced in the say context of the India UAE treaty and in the India Singapore treaty. In the India UAE treaty and in the say Middle Eastern countries, this becomes even more important because there the lower level authorities litigate that if this provision, if this residuary clause is given effect to, then the person will end up not paying taxes anywhere. He will not pay tax in UAE, Kuwait, wherever in Middle East, because there is no similar personal tax provision there. Okay. In Singapore, there is no concept of capital gains. And India, you are claiming this exemption. Doesn't matter. You will still be entitled to this provision. You will still be entitled to this exemption. Only your disclosure in the return form, your TRC, your Form 10F needs to be filed appropriately.
So I think, again, kind of bringing everyone's attention back to the slide, it's a very interesting provision wherein, because of, you can call it a miss in the law for that matter, that they have not included these particular assets of units of mutual fund and debentures, that we are able to kind of take a position which is now backed by judicial rulings, that your income from mutual fund for most of the countries largely are actually exempt, and you can take a view that you don't have to pay taxes on this. So while obviously on a case-to-case level, we'll need to go deeper into how you are situated, how your investment was made, how long it has been, so on and so forth. But the larger umbrella has given you an option to kind of take a view that your income tax gains might be exempt from taxes here. Right?
Just one important point over here. As I mentioned,
Yeah.
not all treaties have this provision. The treaties that we have captured here are not, means we have not captured the names of all the treaties where this provision is available. I'll tell you the names of some treaties where this isn't available, like your US treaty, UK treaty, Australia treaty, China treaty. These treaties don't have this residual clause. There, the mutual fund gains derived by a resident of these countries will be taxable in India. Okay, that is number one. But your Singapore, UAE, Middle East, में most countries में it is available. Europe में तो almost all treaties में we have this provision. Then the next thing is that the litigation that we have seen on this point here in India is that at the lower level, the authorities argue that while the word that is mentioned is share, mutual funds are similar to shares, right? Because you have an underlying interest in the particular asset, right? Okay, but there, reliance has been placed by the courts, and when I say the courts, it means the High Court and Supreme Court and some other decisions wherein it has been held that mutual funds are a separate ball game altogether. Even your SICRA, the Securities Contract Regulation Act, which is which the SEBI deals with, there also the mutual fund units and your shares are treated separately. There is a Supreme Court decision in the context of Apollo Tyres wherein the department tried to argue that your mutual funds units are similar, means not mutual fund units, the UTI units are similar to shares. There also the department said that the Supreme Court said that it is only for a specific act where that where those units, UTI units, can be equated with the shares, and this cannot be a general principle, and this cannot be extended to the Income Tax Act also. So this is a safe provision, and we have seen that the lower level authorities have also started accepting or recognizing that this benefit is available under the treaties. When you say position this appropriately and you disclose this appropriately in your ITR form, and you obviously substantiate this in your submission if the scrutiny gets picked up, and this is backed up by judicial precedents as well. Any question over here?
Yeah, can I ask a question?
Yeah, please go ahead.
Yeah,
hi.
please go ahead.
Yeah, hi everybody.
Hello.
So, see, I wanted to check this DTA thing. So, how is it like, if the tax has to be avoided, then is it because any country have a DTA, then the tax can be avoided, or is there some provision within the DTA which restricts India authority to cut the tax? That is question number one. And question number two, can you explain in context to Canada? How does it go that side? Yeah.
So, okay. So, first thing that you'll have to check is whether India has a DTAA with that particular country. That list is easily available on the income tax website, and you can easily find that by way of a Google search as well. There are very few countries with which India does not have a DTAA today. I can think of a few names. I think one is Chile, one is Peru, there are only a handful of Costa Rica is another country. So these 3-4 countries that are there, India does not have a DTAA with these countries, but largely with all major nations, India has a DTAA. Every DTAA will have different language. Okay, there are provisions that you would need to see within that particular DTAA. This specific article that we are talking about, that is there in at least 50 to 60% of the treaties. Now, this cannot be applied as a general principle. You will have to still do your research. You will have to find out the particular treaty that you are talking about. If you are talking about the Canada Treaty, especially, in my means, if I vaguely recollect, this provision is not available in the Canada Treaty. Canada Treaty may mutual, if suppose you are a Canadian resident and if you have mutual fund related capital gains here in India, I think they will be taxable in India. That residual clause is not applicable in Canada.
Yeah, okay. So
Makes
DTA with
sense.
Canada is there, but just because that clause is not there, hence it will be taxable.
That is correct. You are right. Yes, that is
Correct.
correct.
And how about Australia?
Australia में भी नहीं है.
Okay.
Yeah,
मतलब
means the
DTA
capital
भी
gains
DTA नहीं है.
नहीं, DTAA है. Capital gains
Okay.
article में residual
But
clause नहीं. There is a capital gains
residual clause.
article,
तो वो
but
TDS जो है
there is
म्यूचुअल
no
फंड में वो कट होगा.
कट होगा. नहीं, TDS शायद आपको अभी भी कट होगा अगर से UAE का भी कंटेक्स्ट देके, unless you submit the relevant documents to the broker, वो TDS काट लेगा उसके ऊपर. आपको फिर रिटर्न में क्लेम करना पड़ेगा उसका. या तो आपको in advance you'll have to give that certificate to the broker. See, what happens is that TDS जो है ना, वो that is a the TDS onus is on the deductor. Okay, so many a times what we have seen is that अगर आपको ये treaty benefit available भी है ना, so the deductors act very conservatively. They say that अगर आपको benefit लेना है, आप अपने return में ले लो. ठीक है? They will not do this. They will not grant you the benefit at the TDS stage. There are say a handful of people who are familiar with the international tax provisions and who, based on say an opinion from say a chartered accountant or a big four firm, they may go ahead and give you this benefit. But अगर suppose आपका TDS हो भी रहा है, merely because TDS हो रहा है, that does not mean that you are not entitled to a benefit in your return. You can still claim that at your return stage. That is not a problem at all. But yes, if अगर आपका TDS करना है, तो you should definitely have an upfront conversation with your broker. Say, just to take an example, Zerodha hai, so you can have a discussion with the treasury team or whoever your relationship manager is, and then that person can maybe guide you to the correct person, and then you can initiate a conversation with them saying that this is not taxable in your hands based on this provision of the treaty, and then you can seek the relevant provision, the exemption at the TDS stage itself.
Right. So some investors who are based out of Dubai and Singapore, they submit TRC and claim a waiver of TDS. That
is correct.
is fine. That is correct. So
Absolutely.
my other question was, if somebody is doing this, I mean, okay, there's a provision in law, but does it? What is the fallback? Is it that some tax scrutiny will come up their way, or the tax guy is not going to give it so easily? Practically कैसे रहता है?
Okay. Fair question. When there is a provision under the Indian tax laws and under the DTAA, the Indian tax laws, there is a section 90 in the Indian Income Tax Act, which says that the taxpayer has the right to choose that means he has the right to choose the DTAA provisions or the Act provisions, and whichever is more beneficial, that provision will apply to him. The Act से आता है. Okay. Then the authorities have to acknowledge the fact that DTAA ke provisions, if they are beneficial, they'll have to grant that interest. Having said that, there is no guarantee that at a lower level the authorities will not litigate that. Just because a scrutiny has been initiated, that does not mean that you will not get this benefit. Eventually, if you cite, आज के डेट में तो इतना judicial precedents are available. If you cite the relevant case laws, if you represent your case properly, there is a fair chance that you will get this benefit. If your case gets picked up for scrutiny, there is a fair chance that you will get this benefit in front of the tax officer itself. Otherwise, if your claim is legitimate, then you can fight it out and appeal में जाके you will definitely get a waiver. If at all you get an unfavorable order at the lower level.
Perfect. Thank you. Thank you, Abhishek ji. Thank you, Kapil ji, for your question. In view of the time, we'll kind of cull the questions here. And Chayan has sent a link on the group chat. If you are interested to get a evaluation of your tax status done, or if you would want to get a evaluation of your exemptions, treaties, what can you do better overall in your investing and your tax planning to kind of structure your investments and taxes better. We have added a link and a QR wherein you can book a call with us, and we can do a one-on-one consultation for about 30-35 minutes and see if there is something that we can specifically help you out with. With that, I thank everyone for joining on the session, and I specifically thank Abhishek for taking out the time and helping us, understand all of these nuances, getting a sense of what we as investors need to know. And we hope that he will join us in the future as well for more such.
Absolutely, it was my pleasure, and I hope that the audience enjoyed the session. And it was helpful for them, and obviously look forward to conducting more such sessions for your wonderful audience, Abhishek. Thank you so much for the opportunity.
Thank you, everyone. Thank you. Have a good weekend. Take care.
Thank you. Thank you, everyone.